Welcome to the Explainer. Okay, today we are doing something I find absolutely fascinating. We are essentially stepping into the shoes of a financial detective. We're going to use the Puratan Bharti framework, which is basically our ultimate investigator's field guide, to decode a business completely from ground zero. We are going to look way past those shiny, overproduced corporate presentations to uncover a company's true, undeniable worth. It's all about finding the gritty reality behind the numbers. So let's kick things off with what is basically the golden rule of our investigation. Balance sheet impresses you, factory convinces you, but cash flow decides your returns. This right here is the core philosophy of the whole framework. Look, anyone can make a spreadsheet look beautiful, right? A balance sheet is literally designed to impress you. But as investigators, we have to look past those polished, perfect numbers. We need to find the physical reality of the business to figure out if the cash flow, the actual money returning to your pocket, is real or just a clever illusion. To get there, we've got a 5-step roadmap for our investigation. We're looking at survival before growth, ground truth versus books, the operational engine, validating the numbers, and finally, the final verdict. Let's get right into it. All right, step 1, survival before growth. This is where we analyze the capital structure. So, first things first, how is this company actually getting its money? Are we looking at debt, equity, or some kind of hybrid setup? As financial detectives, we've got to check two vital signs right off the bat, the debt-to-equity ratio and the interest coverage ratio. Think of these as the financial blood pressure of the business. If a company relies way too heavily on debt just to keep the lights on, they are living on borrowed time. We need to see if their equity foundation is actually strong enough to support that debt load. Which brings us to the million-dollar, well, maybe billion-dollar question. What happens when those EMIs actually hit? It's a simple question, but man, is it brutal. You have to look incredibly closely at their EMI obligations and repayment schedules. Because if the capital structure is weak and those repayment schedules are going to completely crush the company's cash reserves, well, our investigation ends right here. Honestly, if a company cannot survive its debt, everything else, their amazing new product, their visionary CEO, their massive growth targets, is entirely irrelevant. Survival trumps everything. Moving on to step 2, ground truth versus the books. Time for a physical reality check on those assets. Here's where we step away from the spreadsheets and ask what's written down versus what actually exists in the real world. Imagine a company pulling in, say, 150 crore in revenue, but on paper, they claim their land is worth 300 crore. Now, your detective senses should be tingling here. You have to ask, is that land massively overvalued just to make the balance sheet look good, or are those assets just sitting there doing nothing? We want to see assets that are sweating. We want assets actively working to generate that revenue, not just lazy assets sitting around inflating the book value. Now, what's really interesting about this is that physical location brings its own hidden risks. It's not just what the asset is, it's where it is. If a company has assets sitting over in Europe, for instance, you suddenly have global exposure. You've just introduced euro and dollar currency impacts into the mix. This is a crucial currency risk that a clean, simple balance sheet might try to obscure. But reality never hides. So what's the ultimate way to uncover the truth? You actually go visit the factory floor. The balance sheet tells a nice story, sure, but the factory? The factory tells the truth. Here's your checklist for when you visit. Are you looking at state-of-the-art machinery, or is it totally outdated? Are those machines actually owned by the company, or are they bought secondhand? Look at the automation level. Watch the actual efficiency and production flow. Is it chaotic or is it smooth? And crucially, what is the maintenance quality? Let me tell you, a poorly maintained secondhand factory floor reveals a gritty truth that those pristine financial books were desperately trying to keep from you. All right, stepping into phase 3, the operational engine. Let's look at capacity, sourcing, and sales. Let's pop the hood and see how this engine actually runs, specifically looking at capacity utilization. This is a massive, and I mean massive, profit lever that often flies completely under the radar. We can break this down into 3 distinct zones. If utilization is sitting below 70%, you are looking at pure inefficiency. They basically built too much factory for way too little demand. Now, if they are in that 70 to 85% zone, that is the sweet spot. That's operating leverage right there. It's where profitability really starts to take off. But if they are running above 90% utilization, that's an expansion trigger. They are maxed out, which means they're going to need to spend capital soon to grow. Knowing exactly which zone a company is in tells you volumes about what's going to happen in their immediate future. Now, true margin stability, that doesn't just magically happen. It comes entirely from this exact matrix, the dynamic between the sourcing team and the pricing team. On the sourcing side, what's their raw material dependency like? Are they relying heavily on imports, or do they have a solid domestic focus? Then, look at the pricing team. If raw material costs suddenly spike, do they have the power to pass those cost increases onto the consumer, or are they just price takers, forced to eat the losses themselves? I'll tell you right now, a strong sourcing team combined with a powerful pricing team is the absolute ultimate formula for unshakable profit margins. But hey, you can have the best factory and the best margins in the world, and none of it matters if nobody is actually buying this stuff, right? We've got to validate the real-world demand by digging into the sales engine. We need to measure the overall strength of that sales network. We need to analyze their mix, like how much is institutional sales versus retail, and we absolutely must check their geographic diversification. A diverse, well-distributed sales engine is literally the only way to prove that the demand for what that factory is pumping out is actually real and sustainable. That takes us right into step 4, validating the numbers against the rest of the industry. Listen, if you take away one thing today, make it this. Never, ever trust company data in isolation. Just don't do it. The company is obviously going to paint the rosiest picture possible for you. You have to cross-examine their claims against the outside world. Go read industry magazines, pull trade reports, rigorously check competitor data. If the company were investigating claims they're growing at 20%, but the rest of the industry and every single competitor is shrinking by 5%, you have to stop and ask why. Because usually, the truth is going to align with the broader industry reality. And as part of that validation, we really have to put their profit quality under a microscope. Where is that profit actually coming from? Is it from their core operations, like making and selling their actual product? Or is that profit being padded by one-offs, maybe selling off some real estate or some, let's call them clever accounting adjustments? We want high-quality earnings derived strictly from actual business performance, not from cosmetic tricks pulled by the accounting department at the 11th hour, just before the quarter ends. Okay, we've made it to step 5, the final verdict. Time to look at efficiency and shareholder rewards. To hand down our final verdict, we rely on the absolute core of valuation, efficiency metrics. Specifically, we're talking about return on assets, or ROA, and the asset turnover ratio. Now, I know these sound like dry finance terms, but these metrics answer the ultimate question. They tell us, are those physical assets we saw sweating on the factory floor genuinely making money? It definitively proves whether that heavy machinery and that expensive land are actually working for the investor, or if they're just sitting there draining capital. Finally, we need to look at how they treat their shareholders. Specifically, what's their dividend policy like? Are they consistent? A disciplined, predictable dividend payout is literally the ultimate proof that the cash flow we've been hunting for is real. Think about it. You can fake book value, you can tweak earnings on paper, but you absolutely cannot fake cold, hard cash paid out to shareholders. If the rewards are irregular or just a cosmetic trick to keep investors quiet for a minute, the cash flow isn't reliable. Consistent dividends close the loop on our whole investigation. So we've journeyed from the polished balance sheet down into the grease of the factory floor, all the way to the final cash payout. The Puratan Bharti framework gives you the exact tools you need to separate a good story from cold, hard reality. So my question to you is this. Armed with this framework, how are you going to investigate your next business venture? Are you just going to read an impressive balance sheet and call it a day? Or are you ready to do the ground zero detective work to find the real value? Keep questioning, keep digging, and use these concepts to guide your next deep dive. See you next time.